Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Cisco Systems, the networking giant reporting record quarterly revenue as AI infrastructure demand accelerates.
Cisco was founded in 1984 in San Jose, California by Leonard Bosack and Sandy Lerner, who met at Stanford. The company built the routers and switches that became the backbone of the internet.
Cisco went public on NASDAQ in 1990. Today it operates globally, serving over 90% of Fortune 500 companies across networking, security, collaboration, and observability.
Most recently, Cisco reported quarterly revenue of $15.84 billion, up 12% year over year, a record. Non-GAAP gross margin reached 66% and EPS of 1.6 cents beat estimates.
Product revenue of $12.1 billion led the quarter, up 17%. Networking grew 25% to $8.8 billion, driven by AI demand from hyperscalers and enterprise customers.
Services revenue of $3.7 billion declined 1%. Security was flat, and collaboration down 1%. The full-year AI order target was raised to $9 billion, with $5.3 billion booked year-to-date.
Cisco's business model is built around its installed base. 90% of Fortune 500 networks run Cisco hardware, generating software subscriptions and services revenue on top of equipment sales.
Network switching costs are structural. Migrating a global enterprise network means retraining staff, recertifying integrations, and rebuilding configurations, locking customers into multi-year replacement cycles.
The AI thesis: every inference cluster, AI training server, and GPU pod requires high-throughput networking. Cisco's data center switching position makes it a direct beneficiary of AI CapEx.
Against Arista, Cisco competes on platform breadth and enterprise relationships. Arista leads on pure switching speed, but Cisco's security stack and installed base create a full platform lock-in.
The AI infrastructure build-out is a multi-year capital cycle. Hyperscalers are expanding networking allocations, and enterprise AI requires campus and data center upgrades, a demand wave with years of runway.
The near-term challenge is portfolio mix. Security was flat, collaboration down 1%. Both face competition from Palo Alto and Microsoft Teams, while networking accelerates.
Chuck Robbins has been CEO since 2015. Under Robbins, Cisco completed the $28 billion Splunk acquisition in 2024, making it the largest security observability platform in enterprise IT.
The Splunk integration and a 4,000 headcount reduction signal a focused pivot, shifting investment from legacy collaboration toward AI networking and security observability.
The AI order backlog is the primary catalyst. At $5.3 billion year-to-date against a $9 billion target, the Q4 pace implies over $3.5 billion in new AI orders in a single quarter.
Gross margin expansion is the second catalyst. As software and subscription revenue grows relative to hardware, the mix shift should push non-GAAP margins above 67%.
At $213 billion market cap, Cisco trades at roughly 13 times forward earnings. The Q4 guidance of $16.7 to $16.9 billion implies further sequential acceleration. The AI cycle is repricing the stock.
Cisco just reported record quarterly revenue. AI infrastructure demand is turning the network backbone into the hottest trade in enterprise tech.
Let's get into the AI order surge and what the Q4 guide means for the Cisco thesis.
Networking infrastructure, AI orders, and a record revenue quarter, Cisco is back at the center of the next technology build-out. Let's get into the numbers.
Cisco just reminded Wall Street why it matters. Q3 fiscal 2026 revenue came in at $15.8 billion, up 11.6% year over year, beating estimates by $200 million. Non-GAAP EPS hit $1.06 against a $1.03 consensus, and then management nearly doubled their AI infrastructure order backlog to $9 billion in a single year. Shares shot up 17% after hours. I'm Hudson Thomas. And I'm Lana Chen. This was not a quiet beat. This was Cisco signaling that it has found its footing in the AI era, and the street is finally believing it. Today we break down every number, every analyst call, and every reason this quarter changes the conversation around. Let's get into it. For any new listeners, Cisco Systems is the infrastructure backbone of the modern internet. Founded in 1984 and headquartered in San Jose, California, The company makes the routers, switches, firewalls, and software that connect over 90% of Fortune 500 companies to their networks. With roughly 82,000 employees worldwide and a market cap approaching $250 billion, this is not a scrappy startup. This is the company that literally built the pipes of enterprise networking. What makes Cisco so interesting right now is its transformation story. Under CEO Chuck Robbins, the company has been aggressively shifting from a one-time hardware sale model toward recurring software and subscription revenue. The Splunk acquisition, completed in 2024, accelerated that pivot by adding world-class security intelligence and observability tools. The question analysts have been asking all year is whether Cisco can actually grow revenue in an AI-dominated tech landscape. This quarter gave them a resounding answer. Let's start with the headline. Revenue of $15.8 billion. That's up 11.6% year over year from the $14.15 billion reported in Q3 fiscal 2025. The consensus estimate was $15.6 billion, so Cisco beat by roughly $200 million. That is not a rounding error, but here is the number that caused the 17% after-hours spike. Management revealed that AI infrastructure orders for fiscal year 2026 are now tracking at $9 billion. 1 quarter ago, that forecast was $5 billion. They almost doubled it. On the earnings per share front, non-GAAP EPS came in at $1.06, beating the $1.03 estimate. GAAP EPS was 85 cents, reflecting restructuring charges and Splunk-related amortization. The company also reported record non-GAAP operating income for the quarter, which signals that the margin on its AI networking products is holding up despite elevated silicon costs. Margins are worth flagging. Non-GAAP gross margin came in at 66%, down from 68.6% a year ago. That compression is real and mostly driven by product mix. AI infrastructure hardware naturally carries lower margin than pure software. Operating margin on a non-GAAP basis was 30.2%. Net margin landed around 21.8%. These are not alarming numbers, but the trend of gross margin declining is something to monitor if AI hardware competition intensifies. Cash flow for the quarter. Operating cash flow was $3.8 billion, down from $4.1 billion in the prior year quarter, primarily due to working capital timing. Free cash flow came in around $3.4 billion. On the balance sheet, Cisco held $17.2 billion in cash against $30.8 billion in total debt, giving a net debt position of roughly $13.6 billion, manageable for a company generating over $14 billion in annual free cash flow. The company also reiterated its commitment to returning at least 50% of free cash flow to shareholders via dividends and buybacks. And the guidance. For Q4 fiscal 2026, Cisco called for revenue of $16.7 to $16.9 billion, with non-GAAP EPS of $1.16 to $1.18. For the full fiscal year, they raised the revenue guide to $62.8 to $63 billion, with EPS of $4.27 to $4.29. Third consecutive quarterly raise, 3 in a row. That tells you management has real visibility. CEO Chuck Robbins was direct on the earnings call. He said Cisco is uniquely positioned to capitalize on AI infrastructure build-out because it provides the high-speed Ethernet fabric, silicon photonics, and security overlay that hyperscalers and enterprises need to run AI at scale. He also confirmed a restructuring of up to 4,000 jobs to accelerate the company's shift toward AI software and platform development. Now let's talk about what analysts are saying. The consensus heading into this print was cautiously optimistic. 7 buy ratings, 2 holds, 2 sells among the firms we tracked. The consensus price target was around $95, representing roughly 52% upside from where Cisco was trading before earnings. After the print, several firms moved immediately. Evercore ISI was the most aggressive. Analyst Amit Daryanani raised his price target from $100 to $110 and reiterated his buy rating, calling the AI order backlog acceleration a game-changer for the networking industry. He argued that Cisco's ability to supply the Ethernet switching fabric for AI clusters gives it a durable edge over pure-play AI chip companies because every GPU farm needs a networking spine. UBS analyst David Vogt reiterated a buy rating with a $95 price target, emphasizing that the Splunk integration is unlocking meaningful cross-sell revenue as Cisco bundles security intelligence into its enterprise contracts. Goldman Sachs and Morgan Stanley both maintained buy and overweight ratings respectively, with targets in the $88 to $92 range. More cautious on the gross margin trajectory, but still constructive on the long-term AI transition story. The bears, and there are still some, focus on two things. First, that gross margin compression from 68 to 66% signals that AI hardware is inherently lower margin than Cisco's legacy software licensing business. Second, that the AI order backlog is largely driven by a handful of hyperscaler relationships, which could prove lumpy. If one or two of those customers slow their infrastructure spending, Cisco's pipeline visibility degrades quickly. Those are real risks, and we will get to them. Here is the bull case in plain terms. Cisco has the most complete AI networking stack in the enterprise, from the physical switch to the security overlay to the observability platform. The AI infrastructure order backlog going from $5 billion to $9 billion in one quarter is not a coincidence. It reflects the rapid scaling of GPU clusters at hyperscalers and large enterprises, all of which need high-speed networking fabric that Cisco specializes in. And unlike pure AI chip plays, Cisco captures revenue on every compute node that gets deployed, because every node needs a port. Add to that 3 consecutive guidance raises, record non-GAAP operating income, a 2.9% dividend yield, and a forward PE of about 14.6 times earnings, and Cisco looks materially undervalued relative to its growth acceleration. The Splunk integration is still in early innings of cross-selling. If recurring software revenue continues to climb as a share of total revenue, margin compression from AI hardware becomes less of a story over the next 12 to 18 months. Now the bear case, which is more nuanced than the after-hours move suggests. The primary concern is margin trajectory. Non-GAAP gross margin has declined from 68.6% a year ago to 66% this quarter. Every quarter that Cisco sells more AI infrastructure hardware and less high-margin software licensing, that number edges lower. If gross margins fall another 2 to 3 points over the next year, the earnings growth story becomes more dependent on volume, which creates execution risk. There is also the Splunk integration risk. Cisco paid $28 billion for Splunk, one of the largest tech acquisitions in history. While early synergies are promising, integrating a company that size is a multi-year undertaking. Any stumble in Splunk cross-selling, talent retention, or product roadmap alignment could weigh on both revenue growth and operating margins simultaneously. Finally, Cisco announced a restructuring of up to 4,000 jobs in May 2026, about 5% of the workforce. That signals focus and cost discipline, but restructuring creates near-term disruption. Key engineers and sales talent sometimes walk during these windows, and if orders are accelerating while you are cutting headcount, the question is, are you cutting the right people? Let's look at options and insider activity for the read-through. In the weeks before earnings, options traders were pricing in a move of roughly 10% in either direction, a wide implied move that reflected genuine uncertainty about whether Cisco's AI narrative had real numbers behind it. The put-call ratio was running around 0.58, meaning call volume meaningfully exceeded put volume, which is a modestly bullish sentiment signal. After the print, January 2027 $70 calls saw a surge of interest as traders positioned for continued upside. On the insider front, Cisco executives have been consistent sellers under pre-scheduled 10b5-1 trading plans throughout fiscal 2026. This is standard at large-cap tech companies where executives hold concentrated positions. There were no open market opportunistic purchases filed in the 30 days before the Q3 report, neither alarming nor bullish. Insiders are managing liquidity through the standard program, not making directional bets. Looking ahead, the 3 catalysts I'm watching most closely. First, the AI order backlog conversion rate. $9 billion in orders is impressive, but orders are not revenue until they ship and get recognized. Watch Q4 revenue relative to that backlog for signs that conversion is on track. Second, Splunk cross-sell velocity. Management has said they are embedding Splunk's SIEM and observability platform into enterprise security bundles. The pace of those bundle sales showing up in the deferred revenue line will be the clearest indicator of Splunk synergy realization. Third, the Q4 guidance implies another quarter of double-digit revenue growth. If Cisco delivers $16.7 billion or above in Q4, the full-year FY2026 revenue story is locked in and FY2027 estimates start moving higher. And the risks to keep front of mind. Gross margin compression is the number one financial risk. If it falls below 65%, analysts will start cutting price targets regardless of the revenue story. The second risk is macro. Enterprise IT budgets are uneven across verticals, and any tariff escalation on imported networking components could pressure Cisco's product cost structure. The third risk is competitive intensity from Arista networks in AI Ethernet switching. Arista has been gaining share in the hyperscaler networking market, and their margins are higher, which gives them pricing flexibility that Cisco may not have in a downturn. Bottom line, Cisco delivered a quarter that validates its AI infrastructure transformation thesis. Revenue beat, EPS beat, guidance raised for the third straight quarter, and the AI order backlog nearly doubled. This is not a short-cycle recovery story. This is a company repositioning itself at the center of how the world builds AI infrastructure, and the financials are starting to reflect it. The margin compression is real and worth monitoring. But at 14 times forward earnings with a nearly 3% dividend yield and an AI backlog that just hit $9 billion, the risk-reward for long-term investors looks compelling relative to where Cisco was trading heading into this quarter. The thesis is intact, and now it has numbers behind it. When the company that literally built the internet starts doubling its AI order book and raising guidance 3 quarters in a row, that is not noise. That is a signal. Cisco is not chasing the AI wave. It is becoming the pipes that carry it. We are Charged Alpha, the S&P 500 stock encyclopedia. Subscribe for a new deep dive every earnings season, and we will see you on the next one. This content is for educational and entertainment purposes only, and does not constitute financial advice. Charged Alpha is not a registered investment advisor. Always do your own research before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.